Alrighty, let's go ahead and get started. Again, hello everyone. Thank you very much for joining us today. My name is Sydney Rutledge. I'm going to be your host for today's webinar over net unrealized appreciation, or NUA, and other post-retirement strategies. We do thank you very much for being here with us at Bogart Wealth here today, and we hope you find this presentation helpful. If you are new to Bogart Wealth, we do encourage you to scan the QR code on the screen here with your phone. That'll take you to a contact form on our website where you can input your information and an advisor will reach out to get you booked for an appointment. So definitely encourage you to do that if you have not engaged with us before. First, before we jump into today's topic, I want to give you a bit of an overview on Bogart Wealth as a firm. So Bogart Wealth has just under $3 billion of assets under our umbrella here. We are the trusted advisor to over 1,300 households. We are a fiduciary as a firm. So that means we are independent of other big broker dealers. Being independent and being beholden to that fiduciary duty means that we legally have to put our clients' interests above our own. That fiduciary duty is something that we take very seriously. With that being said, we are a fee-only wealth management firm. We don't sell any products. There's no commissions or incentives as advisors to recommend certain investments to you because we get paid more to do so. We are a fee-only firm, which means the only way that we get paid is assets that we manage for you. We do custody our assets with Charles Schwab, big household name. That's for your protection and for ours. This is our executive leadership team here at the firm and our full advisory team. We do also have an in-house portfolio management team, full client service team, a financial planning team, and all the lovely back office folks that help us to run smoothly and offer a good client experience for you. We do have a couple of different office locations. I'm located in our office in the Woodlands, Texas. We do have one in Houston, and then our headquarters is actually in McLean, Virginia. So today's webinar is part of our retirement readiness series. You'll see all the different topics there. Again, today we're going to be covering NUA, or net unrealized appreciation, and post-retirement strategies. We do have lots of different other topics around retirement as well. Definitely encourage you to take a look at those on our YouTube channel and our website as well. We do have recorded versions of past webinars. And then of course we do future webinars as well. So make sure you're on our distribution list so that you get the invites for those as well. For those of you that work with us, you know that planning is at the heart of everything that we do. Most people think that planning for retirement is just about the investment management piece, but everyone's situation is different. And it's important that we focus on your goals and manage the issues that are important to you and your family. Again, if you're new to Bogart Wealth and you've not gone through our financial planning process, really encourage you to reach out to myself or another advisor, and we can talk specifically about your goals that your family are working towards. We would love to run your financial plan for you. That's complimentary. There's no cost to do so. So please take us up on that offer. We'd love to engage with you in that way. All right, let's get started with today's webinar topic. Here's the agenda for today. We're going to start off by talking about net unrealized appreciation, abbreviated to NUA, then go into some post-retirement strategies, estate planning strategies around NUA, tax strategies, and then also how NUA can be used for your cash flow. We'll then wrap up by talking about GTCs, or good till cancel orders, and covered calls. So before we start to dive into the nuts and bolts of NUA, I think it's very important to understand what a qualified versus non-qualified account is. A qualified account is that there's a good part and there's a not so good part about qualified accounts. We'll first talk about the good parts of qualified accounts. These are accounts, often 401ks. They can also be 403Bs or 457s. You'll hear me most of the time mention qualified accounts in the context of 401ks. So the good part about 401ks is that your salary is contributed on a pre-tax basis. This means you saved taxes every single year while also saving for retirement into this type of account. You also paid no tax on the gains or the appreciation until those dollars are withdrawn from the 401k. You pay no tax on dividends that pay inside the 401k. And then in most cases, very fortunately, you receive a company match. Now, there is another part of qualified accounts, which is that there is a 10% early withdrawal penalty of 10% if the money is taken out early. In this context, early is considered before age 59 and a half. So if you do make a withdrawal from one of these types of qualified accounts before you're 59 and a half, they will be taxable as ordinary income plus a 10% early withdrawal penalty as well. The other not so good part is that every dollar, both the original cost that you paid for the investments inside these qualified accounts, plus the appreciation on those investments, is taxed at ordinary income rates when you take the money out to yourself. The last part about qualified accounts is that you do make a promise to the government to take out every dollar during your retirement. The government does enforce this promise. There's a schedule for RMDs, or required minimum distributions. Those RMDs start at age 73 or 75, depending on your birth year. There's a substantial penalty if you fail to withdraw on that RMD schedule. And then your custodian, so where the money is held, is obligated to tell the government if you failed to withdraw on that schedule. So do keep in mind that, that those RMDs kick in at a certain age, and they can be pesky, especially if you have large amounts of pre-tax assets. So on the flip side of that, we just talked about qualified accounts. Let's also talk about what the other option might have been, which is a non-qualified account. You could have refused to make that deal with the government on the qualified accounts, but you will have missed out on some of the good parts about a qualified account, like the company match and things like that. So in the non-qualified account, or these are often called brokerage accounts or retail accounts, all the investments are made on an after-tax basis, which means you had to earn the money and then you had to pay taxes on that money. You then had to use it to live, and then you invested it. So it's kind of gone through the ringer. You pay more in taxes on these dollars because you're contributing on an after-tax basis. You also pay tax on dividends when they are distributed, even if they're reinvested and just bought back into that investment, you still pay taxes on those dividends. You also pay taxes on the gains or the appreciation when the shares are sold. Again, even if it's reinvested. So if you made an investment, it has grown, and you sold it to realize that gain, and then you turn right around and buy something else with that money, you still have to pay capital gains taxes on that appreciation. You also did not receive company match in this brokerage account. Again, that's one of the big benefits of saving in a qualified account like a 401k, is that most of them have company matches associated with it. That's free money that you get just for contributing up to a certain percentage. Then there is the good part of non-qualified accounts, in contrary to the qualified account, which is there's no such thing as an early withdrawal. There's also no such thing as an RMD. So the government does not force you to take out a certain percentage on a schedule of the dollars in these qualified accounts, and you can withdraw from them at any point in time, no matter how old you are. It doesn't matter if you're 59 and a half, 49 and a half, or 79 and a half. It does not matter. There's no early withdrawals, no RMDs. And the other good part about it is that any appreciation, not the cost basis, but any appreciation will be taxed as capital gains, which capital gains rates are typically always lower than your ordinary income rate. So it saves you a little bit on taxes there. So now we get into the mechanics of NUA. What's the deal with NUA? It is another deal that you're making with the government, similar to a qualified account, but it's best to understand all the aspects of NUA before you make a decision on what it is you want to do. NUA essentially allows you to move assets from a qualified account to a non-qualified account. It's as if you can pretend that you bought some of those 401k or qualified account assets in an ordinary brokerage account, and therefore only have to pay capital gains taxes on the appreciation instead of ordinary income if they stayed in a qualified account. The major caveat to NUA is that it only applies to employer stock within that qualified account. It can include stock that is received as a company match, and you can typically choose what dollar range of shares you'd like to declare NUA on. The other caveat to net unrealized appreciation is that it must be part of a lump sum distribution from your 401k. This means that you have to take out the entire 401k account in order to be able to declare NUA. You can't simply declare NUA on a portion of your employer shares within the 401k and then leave the rest there to continue to grow. It does all have to come out. Now, in mind with this lump sum distribution, it has to be the first distribution since a qualifying event. The government sets these rules as to what is considered a qualifying event, In the case of NUA, it is separation from service after the age of 55. So if you do separate from a company prior to 55, you'd have to wait for age 55 to be able to do NUA unless one of the other qualifying events applies to you, such as attaining age 59 and a half, disability, or the least fun one, which is death. Again, you must remove everything from the qualified account. Anything that you do not declare as NUA or take as NUA can be rolled over to an IRA. So it stays in that pre-tax environment, and there must be nothing left in that 401k at the end of the calendar year. So that's one of the things that you need to be cognizant about of the timing of NUA. I try to not do NUA probably after Thanksgiving, just because it gives such a short window of time. If there are any leftover residual dividends or something that pay into that 401k in the last week or two of December, lots of people are on vacation and it's kind of difficult, it can be stressful to maybe get those dollars out of the 401k. So just make sure you speak with your advisor about the timing of doing NUA. So why is it called NUA? NUA is one of those acronyms that, unfortunately, knowing what it stands for doesn't tell you a whole lot about what it is. What it is moving assets from a tax qualified account like a 401k into an ordinary brokerage account in order to reduce the tax rate on the gains. Another word for gains is appreciation. And it is only the net, that is the difference between the current market value and the original cost basis. Until you actually sell the stock, the gains are unrealized, hence net unrealized appreciation. Again, tax benefit for distributed employer stock only. The lower the cost basis on those shares of employer stock, the more attractive those shares are to maybe potentially declare NUA on, and also the higher the market price. So the more unrealized appreciation you have, the better. The primary reason people do NUA is to save money on taxes. And the primary difference is this. If you leave your company shares in the 401k or you roll them in kind over to an IRA, when you sell the shares and withdraw the money, you'll be taxed as 100% ordinary income. So those shares are not, if they come out of an IRA, they're not eligible to be taxed at long-term capital gains rates. You will only pay ordinary income on those shares. Also, if you choose to do NUA, then you pay ordinary income on the cost basis of what you paid for those shares. And then the long-term capital gains is applied on the appreciation. So therein lies the tax savings. In this particular illustration, you can see on the left side there, the navy blue bar. Again, if you leave the shares in a 401k or in an IRA, they're 100% taxed as ordinary income when they're withdrawn in retirement. But instead, if you declare NUA and transfer them in kind to a brokerage account, only the cost basis of those NUA shares is taxed as ordinary income. The remainder of the gain is taxed as long-term capital gains. This shows you a comparison between capital gains rates and ordinary income rates. Again, I mentioned earlier, the capital gains rates are always lower than ordinary income rates, and this kind of shows you. So again, if your ordinary income rate is 10 to 12%, your rate that you pay, your tax rate that you pay on capital gains is effectively zero. So much, much lower. If you're in the 22% and then part of the 24% bracket, then your capital gains rate is 15%. Again, 32 and 35% tax brackets are the 15% plus the 3.8% that's called Obamacare surcharge that was implemented a few years ago. And then if you're in the 37% tax bracket, you're going to pay 20% on your capital gains, and you could also have to pay the additional 3.8% Obamacare surtax as well. But again, capital gains rates are always lower than ordinary income tax rates, which is why NUA might make sense if you have employer stock within your qualified account. This might be easier to understand if we actually put some dollars behind it. So again, the lowest cost basis shares are the ones that will always be the most favorable for NUA. In this particular example, let's say you have employer stock in your 401k with a market value, right? So current market value of $500,000. If you decide not to declare NUA on any of those shares, that $500,000 will roll to an IRA in retirement, or you could potentially leave it in the 401k. All $500,000 of those dollars will be taxed as ordinary income when they come out of that 401k or IRA and are distributed to you. On the opposite end of the spectrum is doing NUA, where let's say that $500,000, again, market value, you only paid $100,000 for those shares and they've appreciated and are now worth $500,000. So the cost basis is $100,000 and the net unrealized appreciation is $400,000. If you declare NUA on all of those shares, then you will only pay ordinary income tax on that $100,000 of cost basis. The remaining $400,000 of NUA is taxed as long-term capital gains, again, which are always lower than ordinary income rates. So hopefully putting dollars behind that helps drive the point home just a little bit more. It's not as complicated in practice as the words might make it sound. If you have company stock within your savings plan or 401k, you have a choice to make at the time of distribution. Do you want to move those shares to an IRA or do you want to move some of them to an ordinary brokerage account as NUA shares? Again, this just drives home the first major caveat of NUA is that it only applies to employer stock. It does not apply to any of the other investments within your 401k. Now, one of the things that makes NUA potentially interesting is that if you have pre-87 or post-1986 after-tax contributions in your 401k, you could, and I say could because there are caveats, which we'll get into, you could use those after-tax contributions to make NUA even more of a tax benefit to you. Now, that's not the only option you have with those after-tax contributions. Let me be clear also, different plans have different rules. So this is definitely something that you need to engage an advisor to help you work through, or at the very least, if this is something that you are thinking about doing yourself, call your 401k provider and ask them if you know you have after-tax contributions within your account. Call and ask what the options for those after-tax contributions are, because unfortunately, again, different plans have different rules and you may not be able to use all of your after-tax contributions for one of these options. So what's option number one with those after-tax contributions? You could withdraw them and just take them as a distribution to yourself. You could use them for living expenses and take them right out of the 401k into your bank account. You also could, they're after-tax dollars, so they could roll into a Roth IRA. This has been an option since 2015, and this can be, depending on your situation, a better use of the after-tax contributions than using it for NUA. But again, caveat, everybody's situation is different. Please talk to an advisor to see what your best option is. Then the last option that your plan may allow for after-tax contributions is you could use those after-tax contributions and apply them to the cost basis of the NUA shares. And you might be saying, apply them to the cost basis. What does that mean? Where do they go? NUA is a tax strategy. It is a tax loophole. By definition, loopholes tend to not make perfect sense. And what I mean by this is those after-tax contributions, it is essentially like you're telling your 401k provider, hey, 401k provider, how do you know that I didn't use these after-tax contributions to purchase my company stock? And the 401k provider says, you know what? I can't prove that you didn't use these after-tax contributions to purchase those stock. So if you purchase the shares with after-tax dollars, then they should go to a brokerage account. Okay, great. And then they send the shares to a brokerage account and the after-tax contributions offset the cost basis. That's mechanically what's happening here. Again, under the hood, it doesn't actually look like that, but that is a potential way to leverage that after-tax money and save you potentially on having to pay ordinary income on the cost basis of those NUA shares. This illustrates the way that we like to think about the distribution from your 401k plan. So your company shares will be distributed between NUA shares and non-NUA or IRA shares. So again, low cost basis shares are the most attractive for NUA shares. What if you have shares that you purchased that you bought for more than they're currently trading for? So there's technically no net unrealized appreciation because they're technically at a loss, right? You paid more for them than you could currently sell them for. Well, you don't have to sell those shares and roll them over as cash. You can decide to just keep those shares in kind and they will just roll to an IRA because again, they were purchased with pre-tax dollars. So they will roll over to an IRA to be taxed as ordinary income whenever the shares are sold and the money is distributed to you. So you don't have to sell your company stock. It'll just change location. The NUA shares go to a brokerage account and the non-NUA shares go to an IRA. Everything else, as far as other investments inside of your 401k, different 401ks have different levels of investment choices. Some are very limited and only have 6 or 7 different options. Some of them you can buy the entire stock market if you want to. So when you do a 401k distribution, all other investments besides the employer stock in your 401k are sold and rolled over as cash to an IRA. If you do have anything in a Roth 401k, then it goes to a Roth IRA. And if you have after-tax contributions, again, we just talked about the options for those. You could withdraw those, roll them to a Roth IRA, or potentially use them to offset the cost basis of those NUA shares. Again, we're going to talk about this in dollars because I think it might be easier to visualize. Let's say that you have $2.5 million in your 401k. Most of it is invested in the fund choices of the plan, but you do have $550,000 worth of employer stock in your plan. If you decide you're going to declare NUA on $500,000 worth of shares to go as NUA, those $500,000 worth of shares, which in this situation, we're assuming that the employer stock is trading at $100 per share. So that is 5,000 shares that would go to a brokerage account as NUA. The other $50,000 of employer stock that you have, or 500 shares that you're not going to declare NUA on, but you want to keep them, you don't want to sell them and have them rolled over as cash, those will roll to an IRA as shares. They stay as shares. They don't get sold. Then the other $2 million in your 401k again, gets liquidated. The investments get sold within the 401k, but that the check that's mailed out is made payable to an IRA. So they stay pre-tax. It is a direct trustee to trustee transfer. And though that $2 million in cash will roll over to an IRA as well. In this particular scenario, there is no Roth 401k balance. So let's work the numbers on the tax savings that NUA could potentially generate for this person with these numbers. Let's say that those 5,000 shares are taken as NUA. We're going to assume a cost basis per share average of $29.50. Okay. $29.50 times 5,000 shares is a total cost of $147,500. Let's say, again, this particular person has an after-tax contribution balance of $130,916. You net those two against each other, that makes the taxable portion of the NUA cost basis just over $16,500. We are assuming in this particular scenario that this person is a high income earner that also has state taxes. So their tax rate on their income is 40%. So if you take the taxable portion of the NUA, multiply it by 40%, that is over $6,600 of taxes that you would pay on these NUA shares. Now, you don't have to sell the NUA shares immediately once they're declared as NUA. And usually you won't. Again, that is for you and your advisor to determine how NUA shares are best fit into your plan. They do not have to be sold immediately. But to be able to illustrate the tax savings of those NUA shares, we have to assume that they're sold. So again, in this particular scenario, we're talking about 5,000 shares with a current market price of $100. So a market value of $500,000. The taxable cost basis, remember from the previous slide, was $147,500. That makes the NUA capital gain $352,500. Now, the tax on the capital gains, remember, because capital gains are always lower than ordinary income rates. In this particular situation is 15%. Again, that's what was chosen for this particular scenario. Your actual capital gains rate may be different. So 15% capital gain on the NUA is right around right around $52,000. Again, we take the gross proceeds from the sale at $100 per share minus the tax paid on the cost basis, and the tax paid on the capital gain means that your net proceeds, what you got out of the NUA transaction, is just over $440,000. If instead you had not done NUA, let's see what those numbers would look like. If you sold all $500,000 worth of those shares at a sale price of $100, and then you paid ordinary income on them because you remember you didn't declare NUA on these shares, instead they rolled over to an IRA, and you had a tax rate of 40%, that's $200,000 worth of tax you'd have to pay on that $500,000. So in this situation, if you had not done NUA, your net proceeds would be $300,000. So again, net proceeds of $300,000 if you hadn't done NUA versus $440,000 if you had done NUA. Right, difference of the net benefit of NUA being over $140,000. I think it's helpful to look at this situation again with numbers, kind of maybe help drive the point of NUA home for you. Now, keep in mind too, this is a very complex tax strategy. It took me several times looking at this presentation and years of working with clients on it to fully grasp the concept of NUA. So don't feel like you have to grasp it during this webinar. Again, if you do have follow-up questions about it, or you'd like to see, instead of using somebody else's numbers, and by the way, these are not representative of any of our clients' numbers, we made this scenario up. But if you'd like to see an NUA analysis with your particular numbers, down to the cost basis of your shares inside your 401k, reach out to us. We do have a special NUA analysis that we can run for you, and we'd be happy to go over it with you. Let's wrap up the NUA conversation by talking about some sensitivities with the net unrealized appreciation strategy. So there are some factors that favor more NUA and some that favor less NUA. Let's talk about the more side of the equation first. So if these things happen, it would factor declaring NUA on more shares. If your company's share price is expected to rise in the future, and I recognize that that is somewhat of a crystal ball conversation, and nobody really knows. But again, if there's something on the horizon that's public information, then you may be able to say, "Yep, I think that the stock is going to rise in the future." That could favor more NUA. If you plan to use the NUA shares sooner, i.e. you're going to declare NUA and then sell those shares and use them for a large purchase or a big expense you have coming up, that might favor more NUA. Also, if you're retiring before the age of 59 and a half, remember 59 and a half is that magic age where you are no longer assessed that early withdrawal penalty of 10%. And if you are retiring before 59 and a half, and you can't touch your retirement assets because you're not 59 and a half yet, you have to have a way to bridge that gap. NUA can be a really good way to do that because remember, non-qualified accounts can be withdrawn at any point. There's no age restriction to withdrawing those, and the NUA shares go to a brokerage account. So NUA can be a good way to bridge. Also, factors favoring more NUA is if you expect an excess RMD issue later. Again, this is something that's kind of a sensitivity to somebody's individual financial plan. We would be happy to help you identify whether or not you will have an excess RMD issue later on down the road. That was the more factors favoring more NUA. Let's talk about the factors that favor doing less NUA. If the company's share price is expected to fall in the future, you might do less NUA. If you have no plans to sell the NUA, because in that example that we looked at with the numbers, remember we had to assume that the shares were sold in order to really derive the complete tax benefit from doing NUA. If you're never planning on selling the shares, then you're never going to be able to realize the tax benefit of doing NUA. So if you have no plans to sell it, you might do less NUA or maybe none at all. Also, if you have a preference for the after-tax contributions to go into a Roth IRA, if your plan allows those after-tax contributions to be to offset the cost basis of the NUA shares, if you have a preference for those contributions to flow to a Roth IRA instead, then again, you might do less NUA. This is talking about the advantages and disadvantages of NUA. NUA is a tax trick, and it has a value for many employees, but not for everyone. So let's review the pluses and minuses. So advantages of doing NUA: taxed at long-term capital gains rates. That's a huge one. Not subject to RMD rules because non-qualified accounts are not included in the RMD calculation. They are never, ever subject to the 10% early withdrawal penalty, and they can offset the tax on the cost basis with the tax paid balance if your plan allows that. Now let's go to the disadvantages of NUA. The cost basis is taxed at ordinary income rates. There's also no benefit of tax deferral on any future growth. And there's a significant, for some people, it can lead to a significant amount of employer stock, which can lead to a less diversified portfolio. The dividends on the NUA stock are also taxed as qualified dividends annually. So you will have to pay taxes on the dividends from the NUA stock. All right, that was the NUA conversation as a whole. Again, it is very complex. So if you'd like to engage us to run your specific NUA analysis, we would be happy to do so. NUA is a post-retirement strategy. There's nothing that you can do for NUA before retirement. So what can you do now to set yourself up to maybe take advantage of NUA when you do separate from your company? Number one is you can review your contributions, pre-tax versus after-tax, into your 401k. You can also review the cost basis of your employer stock within your 401k. You can save more. That always is going to help your financial plan. And definitely carefully consider before selling any of your low cost basis shares within your 401k. I know that a lot of 401k providers have the default. If you go in to do a trade in your 401k provider's website, a lot of them have the default setting to where they automatically sell the highest cost basis shares first, because they know that people are taking advantage of strategies like NUA and that they need to protect those low cost basis shares. But again, carefully check that before you sell any shares within your 401k. So today's topic is NUA and other post-retirement strategies. This list is what else we'll be talking about for the remainder of our time today. We're going to hit briefly on some estate planning strategy, cash flow strategy for under 59 and a half, tax strategy, and good till cancels or GTC orders, and then lastly, covered calls as well as other post-retirement strategies. So estate planning strategy, this has to do with NUA as well. Your beneficiaries can also enjoy the tax savings of the NUA strategy. If you are still holding NUA stock at your death, the NUA stock does not get an automatic step up in basis. The heirs will pay long-term capital gains on the NUA amount upon the selling of those stock. If the shares are still held in a 401k, meaning that you've never declared NUA on them, your beneficiaries could choose to declare NUA at the time of distribution if the plan allows it. So just carefully consider the estate ramifications of NUA as well. This is an illustration of what was covered on the previous slide. Again, I find it a little bit more impactful to if this is a situation that might apply to you and your family, rather than going through this entire example. We'd like to sit down with you if NUA is part of your estate plan and run your numbers for you. But we do have an example that we can walk you through as well. Let's talk about cash flow planning for early retirement, early being defined as pre-59 and a half. So net unrealized appreciation, NUA shares can be part of a cash flow strategy for someone that is looking to retire early. Obviously, your savings is also something that you could live on. You could go back to work part-time. Maybe you don't love the job that you're doing now, but you have an opportunity to consult or do some part-time work that you do enjoy. That can help beef up your cash flow as well. You can use your 401k also as part of your cash flow strategy. There is a rule called the Rule of 55, which again, specific situation, but just know that you can use your 401k as part of your cash flow planning in early retirement as well. Some maybe less favorable, but still plausible options for cash flow in early retirement are 72T or a line of credit. 72T is essentially almost annuitizing your retirement assets. It means that you have to take substantially equal periodic payments over a certain period of time. It kind of locks you into taking those distributions for a longer period of time, which is why I said less favorable of an option. Same thing with a line of credit. There's obviously interest charges involved with that. But if retirement early is what you want to do, there are ways to make your cash flow work. Here's some tax and cash flow strategies. The purpose of this slide is just that while you were working, it's really hard to have a tax strategy. If you're earning income, you're paying taxes. Now, once you retire, you have a lot more control over what your ordinary income consists of. So you have a lot more control over the tax implications of your cash flow strategy. That is something that we help our clients do, is to develop a tax efficient cash flow strategy. And that means early retirement and also all the way into retirement. We're always making sure that we're tax conscious for our clients. So on the left here, it just shows different types of income like Social Security, pension income, dividend income, Roth IRAs as well, and then what their consequent tax liability is on the right side. So you can take a look at this. Pension income and interest income as well as IRA and 401k distributions are all taxed as ordinary income. So not too much control over how those are taxed, but you do have control over how much and when you take those distributions, especially in the event of IRA and 401k distributions as well. All right, let's move to the next portion of our discussion. We're going to switch gears and talk about GTCs, or good till canceled orders. These are often used with company shares in retirement. They don't just apply to company shares like NUA does. You can put in a GTC on any stock that you own. They allow you to specify the price and the number of shares you'd like to sell if the price hits that target. So this is an example of a stock that is trading at $110 per share. If you want to say, hey, I see it's gone up on an upward trend, but I am okay with selling that stock at $115 per share, you can put in an order that says, I want to sell X number of shares at 115, and that order will only execute if the share price reaches 115. It can also go the other way, where you can say, hey, sell the stock if it gets down to 108 or whatever it is. You can put a loss stop on those as well. All right, switching gears again, we're wrapping up here. The last thing that we're going to talk about is covered call strategy. This is new terminology for a lot of people because covered calls is an option strategy. And we'll go over some different terminology with covered calls, like the strike price, the time frame, the premium, and the underlying stock. I think this will give, I'm going to read this verbatim because I do think that it has an impact on how you understand call options, specifically covered calls. So this is an intuitive definition of covered calls, if you will. Caveat real quick, most corporate employees cannot participate in covered call strategies on their company stock until they separate from the company. That's why we categorize this as a post-retirement strategy. So, all right, when an investor sells a call option against their shares, so their shares that the investor owns, they are accepting an option premium as payment for giving up all upside potential in the shares above the strike price of the option. In other words, by selling a call option against 100 shares of stock, you are selling the profit potential on the shares above the strike price of the call you sell. Hang with me because we've got an example that'll hopefully bring this home. So in this particular example, this is a recent example. This is actually based on conditions from January of 2024. It's not necessarily representative, but it illustrates how covered calls work. In this particular scenario, the stock is trading at $100 per share. There is a premium of $3 per share that the investor that owns the shares would get paid by the buyer of the option if they were to sell a call. So in this case, the premium is the dollars that you receive, which is $3 a share. The strike price is the agreed upon possible hypothetical sale price in the future. In this particular example, it's $120 per share. Calls are traded in 100 share increments. So one call is 100 shares. 10 calls is 1,000 shares. So if you're going to sell 10 calls, which is 1,000 of your shares at $3 per share of premium, that's a $3,000 call premium. There are a couple of potential outcomes when you sell covered calls. Option number one is that if the stock stays under $120 per share through the expiration date, these are not indefinite, they do have expiration dates, then the buyer of that option is likely not going to execute their right to buy those shares because they're not in the money is what they call them. There's another option where the stock goes over 120 and then the buyer is maybe likely to purchase those shares from you because they've agreed to purchase those shares from you at a price of $120 a share. So let's say, for example, the stock goes up to 130. They're probably going to buy those shares from you at 120 and then turn around and sell them for $10 more per share at 130. Now, you will not have been out, right? You have to sell your shares and they're going to buy them from you at 120 and then probably go sell them in the open market for 130. But they did pay you a $3,000 call premium. So this is a post-retirement strategy where if you're wanting to hold on to some shares, but you want to generate some income, that call premium can be a good option to generate some income on the shares that you are going to hold in your portfolio. This is talking about opportunity cost. Again, if those shares are under option, you can't sell them while they're under option. I mean, you can, but then it would be considered a naked call. And those are typically more risky because you can't cover the position, i.e. covered call strategy. There are some advantages and disadvantages of doing covered calls on your stock. They're not suitable for everyone. Some people love them and some people hate them. So definitely important to talk with your advisor if this is a potential option for you. That is all I have for you today as far as content goes. I really appreciate you sharing your time with us today to learn more about NUA and other post-retirement strategies. Again, if you have not engaged us to do a one-on-one financial strategy session, highly encourage you to reach out to us and get on an advisor's calendar. Let's sit down and have a conversation about your situation. We would really enjoy the opportunity to get to know you and your situation. So please reach out to us. You can contact us by giving us a call. All of our email addresses are on our website. So please let us know if you'd like to sit down with us to engage for financial planning. And again, thank you very much for your time. That's all for our presentation today.